We had and hopefully all the real estate guys are on at this point in time. If anybody's missing, let me know. So we had quite a practice session on real estate prior to this, because real estate is facing the types of issues that it's never faced before. I was going to have a contract attorney speak, but he's out on the Pacific Coast, and he's like, forget it, 6 a.m. is too early for me. Although we're lucky enough to have Mario Gallo leading the discussion. So I'm going to let Mario introduce himself, and then all the other panelists can introduce themselves as well. So thanks so much. Why don't you guys kick off and talk about the world of real estate right now?
Perfect. Gentlemen, Marty, thank you for having me. This is exciting. I'm excited to learn a lot of information here. I've got a lot of questions, and we're going to just kind of be kind of firing away here. Just to kind of manage expectations, as a panelist, my name is Mario Gallo. I'm with SoCal Real Estate Ventures. We build private syndicate funds and promote these funds to the capital marketplace, also known as alternative assets. To manage expectations, I'm going to start off having each panelist introduce themselves. Then we're going to get into the market, where the market's at currently, and then how the market has affected your business, and then start getting into a little bit about market valuations and things of that nature. This is all focused around COVID and how it's affected real estate and post-real estate investments. So if Michael, if you could start off, or actually Camille, let's have you start off, introduce yourself, and you can kind of go down the line.
Very well, thank you, Mario. Good morning, everyone. Camille Homsi, the GRC Investment Group is a single-family office located in Dubai, the United Arab Emirates, while we also maintain investment offices in London and in New York. We are in our third generation as a family, and our goal is capital preservation. We invest in alternatives that include commercial real estate, renewable energy, and waste management technology. Operating companies we also invest in with export components, and in last five years, we added a bucket of life science. We make direct investments. We also partner with other families. Beyond that, we invest alongside leading private equity firms in a separate account structure to capitalizing on their outsourcing and depth of research. As a member of the investment committee, I lead the global strategic expansion team, the global allocation, and the state of the portfolio oversight. Unlike how I normally conduct my business constantly traveling, I have been locked down in the New York metropolitan area since the beginning of March, and conducting my business virtually. I'm happy to join my esteemed colleagues on the panel to share a perspective on how COVID impacted the real estate investment sector globally, and here also in the US. I'm happy to see my friend Kyle wearing a tie. I haven't seen my ties since March, so I leave it for the rest, and thank you.
Kyle, why don't you take it from there?
Sure. Good morning, everyone. My name is Kyle Kadish. I'm in the greater Boston area. This is the first time I have worn a tie in about 6 months. I'm surprised I remember how to tie it. So with my clients, we are looking at all asset classes because we all know the world is much larger than just stocks and bonds. A lot of the transactions my clients are working on are structured strategically to be effective in deferring any gains in depreciation recapture. And that's what we're doing. It's my philosophy that the tax code has been created to stimulate economic growth. It's not simply a revenue source for the government. And we find ways to ensure our clients' money and capital can continue working to grow the economy. Thank you for having me.
Very good. Daniel Me?
Thanks, Mario. And for 6 a.m., you're looking pretty fresh out there, Mario. Thanks for getting up early to lead us here. Yeah. Good morning, everyone, and greetings from Boston. Well, we're kind of pleased. It looks like that switch with Cam Newton for Tom Brady worked out pretty well, at least this past Sunday. We'll see how the season progresses. Go Pats. I'm Dan May, and I'm president of Dillon Capital Advisors, where we provide corporate strategy and capital raising services. I began my career at JP Morgan Chase Bank. I later founded Tremont Realty Capital, which was a SEC registered investment advisor. We were a private direct lender focused on mezz debt. We maxed out, I think we got up to 35 professionals working out of 10 offices across the US. We sold Tremont in 2016. My focus has been in real estate capital markets. So I'm really looking forward to this morning's panel. Thank you.
Joseph, Joseph?
Yeah, I'm here. Good morning, everybody. It's my pleasure to join you guys and speak about the market in general. My name is Joseph Yee, once again, Chief Investment Officer of Real Hospitality Group and a founding partner of LRW Opportunity Fund. Real Hospitality Group is a nationally recognized hotel operator with about 110 hotels throughout the country, with 3 offices in the United States. I'm based out of the New York City office, as you can imagine with my background. We also opened this year our first office internationally in Shanghai, China, to kind of get into the third-party management hotel business, as we think, and we'll go into this in our panel discussion, that the market has been completely disrupted in our sector. LRW is a fund that we started this year, recognizing there's a lot of distress in the hospitality space, and we think there's a lot of ways to monetize that. And we are represented by 3 family offices in that opportunity fund. One is WNW Capital. It's a private investment group that invests in multiple asset classes in various sectors. Once again, we're a hospitality group, primarily a hotel management company. We also invest in hotels, and then Land Group, which is a shareholder and a family office based out of New York City that invests heavily in commercial real estate with a concentration of hotels and considered one of the largest and most prominent hotel investor and developer based out of New York City. I'm happy to join you guys, and Mario, lead the way.
All right. Is that, have we had everyone introduce themselves? Are we missing anybody? Okay, well then let's get into it. Let's try to keep the answers as direct as possible, because we've got a lot of questions here, and I'm excited to learn about it. Let's stay in the same order if we can, right? So first question, what is the status of the current market, and how has it impacted your business, right? Where do you see it moving, and where do you see the marketplace landing? Let's start off with Camille from a worldwide perspective, and then let's zero that into the U.S. and then move it forward from there.
Thank you, Mario. From just looking at our portfolio, we spread from Australia, Asia, definitely Central Europe for many, many years, and now in the United States since 2007. In general, in direct answer to your question, we are on a standstill, on a wait and see, due to the not having a sense of valuation. When I look at offerings that come to my desk, I look at them. I mean, most of those offers are due to owners running, especially in real estate, as we are focusing on this panel, running out of reserves, tenants that are not paying the rent. Other tenants are trying to change the nature of their lease, trying to enforce the force majeure, the interpretation of force majeure between the law, the insurance companies, the lawyers, the landlords. There is a lot of ambiguity in the market, Mario. So in the absence of the ability to evaluate an asset, is 30% the discount is a bargain? If I would commit to that asset, would I look like a fool when I own it and that same tenant who didn't pay rent is not going to pay me rent? While my service contracts are in effect to the elevator service, regardless if you put 6 people in the elevator or 1 person per elevator, you still have to pay for service and maintenance and adhere to the city code or whatever jurisdiction code is the same. Same is for your HVAC, and the same is for all the other services, including security and the other amenities that you have in your building, regardless if it's a hotel or it is an office or a multifamily. The social distancing and also the protection of not only the tenants, but also the staffing is a chaos. Today, after 6 months, we still have people working from home. As long we have people working from home, we are not mobilizing the economy. This economy, Central Europe, Japan, they are a consumer-driven economies. Unless the tenants, the workers, the public is using public transportation, is burning tires, is out on the road doing shopping, there is no way that we will see a true evaluation. And at the same time, we are, on one hand, we are waiting for a vaccine, and on the other hand, we are expecting a second wave. So where do we go from here? I feel like I know nothing about the business. This is a new paradigm. I'm starting all over. I need to reinvent myself.
Hey, Camille, I just want to join in and ask you, there's also the whole other issue of worker mobility, right? I mean, one of the big things of the EU and in America forever has been people move around to new jobs. And I think mobility has become more limited. And maybe that impacts real estate as well.
Marty, your question is definitely on point, but let's take just for a specific example. A group of workers left New York and went to Florida. If they're working from home, what is their contribution to the economy of Florida? You know, after landing there and renting a home or buying a property or using their own, what is their contribution to the economy? I need them in the street. I need them going back to have their lunches not at home, to have them at the restaurant within proximity to their office, to use the parking lot, and also to engage with others. I also have concerns toward our young generation that we always call them the millennial or X or Y generation. That segment of the society will lose the opportunity to have mentorship and also to work on improving their social skills.
And I have to just ask one more question. So New York State is talking about creating a high frequency trading tax, or maybe it's New York City, and New Jersey has also said they may do the same. And the heads of the exchanges have both said, I think the head of the New York Stock Exchange said that he can move in one day all operations. So you might want to, what happens to New York City when it loses those kinds of jobs?
Marty, in the immediate present, we will see an exodus out of those states. And we will find that the 7+2, total 9 states that do not have income tax to become the target for many of those mobilized families and mobilized workers. You know, Tennessee, here in the East Coast, Tennessee, Florida, Texas, definitely New Hampshire are on top desired states for people that are fed up with taxation and also feel that they are penalized for their success. We live in a capitalistic society, and the United States is definitely the mecca of capitalism, and you cannot chase the wealthy and the successful out of those leading states. And New York being the mecca of the United States and the world, we need to keep those people here in the States working, and within the state working, and also to really consider other mobility of the economy beside penalizing the successful.
Daniel, perhaps you could talk a little bit about what you're seeing in the in your specific niche and marketplace, how the slowdown has affected things, what you're seeing in the debt, private equity markets, and you know how one could potentially reinvent themselves in this market.
Yeah, happy to, Mario, and that was a great summary, Camille. Yeah, there's a lot of dislocation going on out there. It's affecting every inch of the business, and the two big open questions are, right, how long will this kind of interim period last, and then what are the permanent changes that we're going to be living with that don't get back to, say, January normal. In the real estate debt markets, the quick answer to where we are today is that there is debt capital available, and I believe there'll be a lot more debt capital available when we get on the other side of this. And the other side from a real estate investor, be it equity or debt, the other side is when we have some clarity on valuation. I mean, price discovery is really tough right now. Might be helpful if I take a minute and go through the major asset classes of lenders, and so you can see there is quite a disparity in how some of these lenders are in business today. The agencies, they're very active. Fannie's actually up as of mid-year for their production versus 2019, and Freddie's flat to slightly down. So they have stepped up, and obviously that's focused on multifamily, but they are absolutely, the window's open. What's interesting, I looked at it the other day, and 75% of their business this year has been refinancing and not acquisitions, and it usually was half and half. So it shows that investors are indeed on the sidelines. They're trying to figure this out. CMBS, which is a big chunk of the market, that basically shut down in March and April. And that was driven mostly by the investors that, they got shocked by the jump in default rates, which had been in January about 1%. They jumped pretty good. There may be 2 or 3% in multifamily, office, industrial, but when you move over to retail, the default rates are 15%, and in hospitality, I believe it's over 25%. To put it in perspective, in July, there was $20.5 billion of hotel loans that were 30 days past due. In the depths of the Great Recession, that only got to about 13 billion. So there's a real crisis going on in hospitality, and it's Joseph will give us some more insights to that, I'm sure, this morning. But from a lender perspective, those are all but impossible to get recapped today by anybody. So CMBS is now open. Lots of scrutiny, lots of heavy underwriting, but you can get transactions done for the right sponsorship, the right deal. Private lenders, which have been the fastest growing part of this segment, and these include mortgage REITs and debt funds. Early on, some of the debt funds really had some challenges with the rapid drop in cash flow. Many of them saw marks to market in their lines of credit, and they had to scramble. Several had to sell a bunch of assets, and others had to bring on some partners. But that market is open. Those guys are smart. They can figure it out. You're going to be able to get more flexible terms than you will from other lenders. Pay a little bit more, but it's very viable and open for business. Life companies, they're sticking to their knitting, very conservative, 50% loans, but they're open for high quality deals at low LTVs. Banks, the biggest difference to this crisis that we have, as compared to the 1990s and then the Great Recession, is the banks. The banks were incredibly healthy in January, so they can absorb a lot of the problems that they have. And frankly, right now, as we sit here today, they're portfolio lenders, most of them, and so they're managing delinquencies, they're mitigating defaults. But once they clean that up, we expect them to be back in full bloom. Mortgage Bankers Association thinks bank lending will be off about 40%, but they are lending to their long-term clients. They've tightened things up, higher coverage, lower LTVs. Don't bring a hotel loan to them. And as they prune their portfolio, what we're seeing is anybody who asks for 2 forbearances under the CARE Act is quietly being shown the door. They're moving to clean up their borrower base, and we're going to see a lot of paper from these banks that want to have, you know, just pristine portfolios. So that's the report from CRE lending, Mario.
All right, thank you. I think, well, you know what? If we can maybe jump around a little bit, Joseph, because I know there's a little talk of the hospitality market. Perhaps you could talk to us a little bit about the winners and the losers in the hospitality market, best way to position yourself, and if you're seeing large amounts of distressed debt or distressed.
Yeah, so we're fully vertically integrated in the hotel space, as we spoke before.
Yep.
We're in the investment side, management side, certainly have full capabilities on anything that touches investments, including conversions, renovations, and operating independent or branded hotels across the board. I think Daniel hit it on the head at and I think everybody in the panel would probably understand the hotel business a little bit easier than some of the other sectors because it's pretty obvious, right? You go to your hotel in your local neighborhood and you see that demand is completely down. The demographics of the clientele is completely different. So from a top line perspective, it's a terrible story. From the kind of other benchmarks, as Daniel mentioned, CMBS delinquency rate is highest it has ever been. And this delinquency rate in the short term is probably much worse than what is being reported, because unlike the last recession, we had PPP loans that buttressed the financials of a lot of the hotel owners for the last, let's say from May through August, depending on when you got the loan. I think the report's gonna come out in August, gonna show you a little bit worse. Top line revenue is also going to show you a little bit worse. So from a winners and losers perspective, if you are holding assets, right, you're certainly feeling the brunt of this. We are, and once again, we're a conglomerate of 3 family offices. One of our family offices owns $1.5 billion of hotels in the New York City metro area. On an average year, cash flow is about $50 to $60 million. This year will be negative $50, $60 million. So if you don't have a big balance sheet, and nor the desire, so you got to think it twice. Do we want to support our portfolio? Do we want to pick winners or losers in our portfolio and then kind of do the workout from there? What's the solution then? So if you're a legacy holder, what are your options? So one option is, of course, go to your lender and try to do a workout. The workout or forbearance, depending on what your strategy is and what your options are, it varies dramatically between the type of lenders you have. So in the hotel world, you have a balance sheet lender and CMBS. You don't have agencies involved in our space. Obviously, if you had agencies, a lot more political support to do some kind of workout with your borrowers. That does not exist in our space. Balance sheet lenders have been easier to communicate with. And that's this recession, last recession. So I don't think, if you're in the CRE world, it's fairly obvious that is simply the case. The CMBS world, because of REMIC rules, have a lot of regimented process, and that process has to work its course. So as we are borrowers of CMBS debt, I'm still yet to have an agreement in place with my lender. Some of it is because I just won't accept the off-the-shelf support or off-the-shelf forbearance of 3 months that they're willing to give you. Because if you look at kind of the long-term trajectory, and it really comes back to kind of market analysis, state of the market part of the conversation, is that 3 months is not going to do anything for me. So just big picture, the market is down 53% as of July month year over year, nationally average. Some markets are doing well. Some drive-in markets are doing very well year over year, almost flat to last year, versus primary markets like Boston, New York. To give you some perspective, Boston is one of the worst hit markets. It is still performing 80%, if not worse, to last year. Same thing similarly in New York. If you talk about Hawaii, which heavily relies on international travel, that is of course all gone as well. So where is the market going to be? Is really that's the conversation where everybody has to kind of think about in our business. So just before I kind of close out here, the way I look at CRE is hotels going to always lead because we lease out by the day. So whenever there's a downturn or upturn, you're going to see the hotel market kind of shifting. And that's the way I would look at it. If you're in CRE investors, look at how the hotel market trades or hotel markets fundamentals perform. That will kind of give you some understanding where you're going to be in your other asset classes in CRE.
Hey, Joe, I mean, so can we get honest about hotel? I mean,
Yeah.
what capacity can hotels, you know, I mean, restaurant restrictions in New York are 25% indoors, right? I don't know. Are there similar restrictions on hotels right now in
Yeah.
major metropolitan areas? Number one. Number two, are hotels going to have to reconfigure themselves, like almost like, you know, the airlines where they leave every other seat empty, at least on Delta? I mean, what's going to be the answer to that, and what are you kind of betting on?
Yeah, operationally, there's always some shifts going on. Prior to COVID, the standard protocols, you essentially change linens, but not the duvet on a daily basis. You clean the bed sheets, the duvet, and deep clean when the guest checks out. You're not doing any of that daily cleaning at this time. So not to get into kind of the weeds, but that's some of the behavioral shifts that's going on operationally. From a long-term perspective, I'm a firm believer in the sector. Obviously, we're starting our opportunity fund because we think that the recovery is going to be there. If you look at the long-term projections of our industry, and we have some disruptions in between, you have the traditional hotels, and then you have Airbnb, and every technology platform you could think about in distribution that came in. But in the long-term trajectory of the hospitality space, especially the last 20 years, outside of these intermittent recessions, we've been performing really well. Internationally, travel is up. As you could see with a lot of airports, especially the international airports, they're all expanding, adding more gates and runways where they can. And that trend is going to continue from our perspective, and data supports that. So we think that long-term, the hospitality is going to be a winner in the sector versus some other CRE asset classes. There are changes, behavioral changes in the consumers in other sectors like retail that I think there will be winners and losers within that sector. And I think overall that sector may have some shifts, but we're long-term believers in the hotel. We think that recovery period is going to be about 4 years. So what do you do in the interim? I guess that story is different for every owner. There are repositionings happening. There are assets that are being purchased to repurpose hotels into residential, multifamily, senior living, homeless shelters. All of that for me is short-term shifts. So if you're long-term holders, I wouldn't shift that quickly. I think the writing on the wall is not there yet on how the hospitality sector is going to recover. The one number I would always track in the hospitality space is international inbound travel. If you look at international inbound travel, we're below 10% year over year. We're right now at 44% from year over year as of, I think the last report was about 2 weeks ago. So that trend is continuing to go up. I think the vaccine will, of course, make a big turn there. And that's kind of what we're looking at. With that said, 2021 in major markets like New York, Boston, San Fran, you could just basically write that market off as the recovery is not going to be there because corporate travel is not going to happen until 2022.
Right. So I know that you're talking about, you know, travel and about the ability to get into rooms, et cetera, but what about conventions? I mean, so many of the major hotel chains in hospitality, they rely on lots of convention traffic, being able to fill in 1,000 seat auditorium, you know, et cetera.
Chicago, Orlando, San Francisco, big convention boxes, Dallas to a certain degree, but like Chicago only goes when their convention schedule is good. So convention schedule really would dictate how Chicago performs. Same thing with Orlando. First half of next year, no conventions coming back on a national scale. You might have smaller associations, but they generally don't hold it in those big, you know, you're not having, you know, very small conventions in McCormick. It's just too big of a space. So McCormick or the Orlando Convention Centers are not going to have material demand for the first half of next year for sure, and probably for not foreseeable future for the full 2021 schedule. So if you're thinking that demand's going to pick up, financial viability of these assets will pick up after vaccine. In major markets, that's simply not going to be the case. It will take another year of dire numbers of severe financial distress until about 2022, and I would say midpoint, where the properties could actually cover debt service. So what happens?
At least 18 months.
18 months. So we think
Okay.
that our distress opportunity window is about 18 to 24 months. 18, fairly confident, and I think the discount's going to be fairly strong.
I mean, I think your distressed opportunity window is larger than 18 months because 18
Yeah.
months is just when it begins to bounce back.
Yeah. Well, 18
Maybe
months.
it's 36 months.
Is 18 months is if somebody hasn't figured out what they're doing with their portfolio after the 18th month, they might be losing the assets back to the lender. If they figure out how to hold it for 18 months, I think the market improvement will potentially get them cash flow positive on the 19th month. And they already suffered through the 18 and supported financially, right?
And Joseph, when does that 18 months start?
I'm really speaking as of today.
Oh, okay, gotcha.
So you asked me 6 months ago, I would have said 24 months.
Got it. I think Kyle, we love to hear from you. And, you know, I know, you know.
No, Camille mentioned early on in one of his comments, I'm not sure if everyone caught on to it, but life science, that certainly is a space in certain markets in cities that will continue to be in demand. I know Dan is looking at that space as well, or has worked there. Certainly in the Boston, San Francisco, and San Diego markets will continue to grow and expand. If we're looking at the office infill, there's been an amazing trend for the past 20 years that's just now reversed, and it's been the average square footage per employee in the space. It's now increasing. So we're going to see likely the exit from infill city centers to more suburban office parks. Some of my other clients are working with, and there's one that's focusing for clients who are, or for the tenants looking for forbearance or forgiveness and concessions for a few months. The firm I'm working with is saying, great, sign that 5 or 10 year extension now on the same terms and we'll give you that forbearance. There are plenty of ways to have it in your advantage and benefit to come on acceptable terms. Other sectors, possibly looking at logistics and distribution, whether it's a FedEx facility or Amazon, just as examples with these societal shifts, probably will continue to be in demand. And essential businesses, those are really areas that my clients are exploring now. I will say, I'm not going to put words in your mouth, Joseph, but just want to make sure you've been speaking generally on full service hotels in major markets.
No,
And
in general, all hotel asset class, but you're right, as you're kind of alluding to, different types of hotels have different challenges. Full serve are suffering more as they rely on group and corporate more heavily.
Yeah, and so I'm also working with a firm who is focused on the limited service space, and they are acquiring now, but presenting an offer to the seller tax advantage through the UPREIT structure.
I think this healthcare space is really fantastic, and there's been a lot of innovation, especially in the lab space. But you know, let me give you a scenario. There's a hedge fund guy who's in a hedge fund hotel that overlooks Central Park, and he's got the whole floor, and there's a conference room that seats about 100 people, overlooks Central Park on 59th Street, and right now he's the only guy in the office. Okay, so from what I know, the rumor is that he practices his yoga in the conference room overlooking. It's fantastic, right?
Nice.
I mean, is that sustainable? Tell me.
You know, all the predictions are premature, Marty. We still do not have a clear vision of how the recovery might be. The United States today is not only hit by a pandemic, but the United States is looking today for looking forward to two things: looking forward to a vaccine and looking forward to November 3rd. November 3rd is going to make a big difference in the life of the United States, not only now, but also for many years to come. There are many leftist ideas, there are many conservative ideas, and they're clashing. And the business environment is today the victim of this, because taxation and also several governments, including the government of New York City, let's be clear on this, has been non-friendly to the entrepreneur, and especially to the real estate sector. And that is also creating a situation of, I don't want to go to the extent of saying fear, but also of being reserved and wait and see. Everyone we talk to say, you know, November 3rd is going to make the difference. Is it going to be more taxes? Is it going to be more leniency? Will there be intervention to enforce the law by the federal government? Because investors need, when I, for example, come out of Europe in the mid-2003 to start looking into building a portfolio in the United States, my drive was what the United States offer, and on top of it is security. An investor needs security. Investors need to know that they can enter and they can exit. New York City had experienced in 2018, 60 million tourists coming to New York. That's what fills the hotels for many portfolios.
Just to touch
Where
on
are
that.
they today? And are you going to bring back 60 million people in a short period of time? This is going to be a big question mark, Marty. Ready for
Camille, I mean, the tourism isn't just New York. What about all these European countries that have deindustrialized devoted to tourism?
They're suffering from the same, because these are all, Marty, consumer-driven societies that they need the consumer spending and consumer confidence. But at the same time, they need security. I know from our families in the Gulf states, we have high temperatures in the summertime, as you know, north of 100 and 110. So normally our public go up to the Mediterranean or go up to Central Europe. Due to the unrest in Central Europe, people have been seeking destinations in Singapore and Bali Island and the Mauritius Islands, and also in the Eastern Balkan states. They haven't been going to Western Europe and the central countries due to the lack of security also. So investors need security, and security first. The United States has a lot to offer a myriad of advantages, but security is going to be a problem for a lot of people when they are assessing capital allocation.
Well, guys, in that respect, actually, when looking at, let's say, the U.S., where there's riots and certain government procedures that are different in each state, how does that affect market valuation of properties and debt markets?
I mean, I think the biggest risk in the short term to CRE is actually, and every market has different disruptions, social disruptions. Biggest risk is, municipalities' balance sheets, right? Because municipalities, 50% of their revenue, generally speaking, comes from property taxes. So your biggest risk right now in the short term is what's your property tax going to look like in 2021. In the hospitality space, depending on municipality, that's your second or your most expensive expense line to the market. Our sector had a very big macro shift, and this has to go back into politics a little bit and trying to stay away from that. But that had a lot of these big markets, Portland, Seattle, increasing minimum wage, and they dramatically increased it overnight, 30, 40, 50%, if not double overnight. So that was your big headwind risk that our sector was looking at for the last 5 years. We're out of that. We kind of came out of it. It's already priced into the market. What's not priced into the market is potential CRE tax increases. And that, in effect, is the biggest problem because municipalities can't cut their own checks, right? They can't print paper. So they're going to need some federal assistance on that. And that is the biggest concern. And you'll see that, short term, we'll find out in 6 months. We'll find out in 3 months.
I don't think it's going to affect.
What kind of CMBS is becoming due in the next 6 to 18 months in terms of
Yeah, I don't know. I'm never worried about maturity for CMBS because we talk about that every 2-3 years, like there's going to be a big maturity. There's a lot of liquidity in CRE, both equity and debt, and a lot of debt or equity plays like that. It's kind of a pricing issue maybe, but probably less than 100 pips of risk that I will
Gotcha.
price on
Okay.
CMBS.
So you think there's a possibility just to roll stuff over, and even though some valuations may have been hurt, it's not that significant?
Yeah, I mean, there's a lot more players in 2020, or let's say 2019 versus 2000 in the CRE financing market.
Joseph,
It's
really dramatic. When you look at the CRE private equity market, I mean, there's dry powder out there. Over, it's about $340 billion, which is 2x what it was in 2009. And so you won't have a free fall in values. There's so much money, both debt and equity, on the sidelines looking for opportunities. There's a reason there's so much dry powder accumulated. These guys are smart. They're looking for deals in real estate. There weren't a lot of deals, really hard to find value in January. So these guys are ready to jump on value. The bid ask right now, from what I'm seeing, is pretty tight. You know, there's only like a 5% discount being offered, and the investors seem to want something north of 20. And as Camille noted earlier, we still don't know if that's the right number. But when the time comes, money will be there to support reasonable deals.
Yeah. But, okay, so how about a different scenario? I mean, you guys are really smart. You're different. You're like a think tank. But here's my other scenario. So a lot of these chains, public companies, whatever, they all assume that there's going to be some kind of a growth curve, and maybe they, had credit based on that. There's been mergers and acquisitions in the space. I mean, does that impact anything, or you think it's really people are going to be able to sustain it? I mean, will there be layoffs?
When it comes to pricing of the real estate?
I mean, so we run an event every year at the Hyatt Hotel in Miami. They laid off or they furloughed, half their staff. They're not doing events, right? I mean, how much of that is going to occur? It's going to be some bleeding going on, right? Thoughts?
Marty,
there always will be, and the operator, not necessarily the landowner or the real estate investor, it's going to fall on the operator. The real estate investor will always be working to negotiate the best terms for them and their own clients. I don't see price dislocation in the long term. I see the greater long-term trend being insurance premiums to cover these unknowns.
Are we seeing different trends and shifts in allocation? Are you seeing the monies flow in certain areas?
Absolutely. You have winners and losers in the property type, within the property type of commercial real estate. I personally have been directing my site toward data centers, and though we've been data center investors in the Baltic republics since 2012. And where those countries are providing incentives and also the infrastructure for data centers. Here in the United States now, I see growing demand in building and retrofitting research centers. Like Kyle mentioned before, I mean, you do have destinations between Boston, San Francisco, San Diego, and London. Those are today the main centers for pharmaceutical and medical research. So would I be looking at investing in the near future in senior housing, in student housing, or in hospitality? No, not for the near future. I want to see my way clear. So is there a shift? Absolutely, there is a shift. We do have ownership in office buildings in various destinations in the United States. We haven't been hit heavily, but I do expect also a shift into the way we operate and we maintain those assets. So definitely there is mobility, but there is a lot of ambiguity still at the same time.
So, Daniel, what do you think? Oh, go ahead, Kyle.
No, I was just going to say the challenge with allocating, most investors are familiar with a 1031 exchange, and you have the restrictions on the timeline, limited inventory, and will you be able to close on the deal in time? That's why we're using other parts of the tax code to let the investor maybe even sit on the sidelines for a more attractive valuation for however long they want and still defer the tax liability. I've been, the firm I work with doing this has been involved for 25 years. That even allows investors to move outside of real estate for the time being, or defer capital from other appreciated opportunities, defer taxes from other depreciated, highly appreciated assets, and redeploy the full asset base back into real estate on their own schedule.
Right. Like I personally know there's certain investments such as film, oil and gas that people could 1031 exchange into as well, for example.
Yeah, this is just structuring the transaction in a way using the installment sale method 453, which can, when done effectively and correctly, provide a much larger capital base to work off of.
Hey, people are getting creative, Mario. In terms of reallocations, there are investors now I know that are looking at office buildings in the urban core of Boston. And, office is under pressure, and we don't know what it's going to look like on the outside, but urban office is considered to be, there's an oversupply of it. So there are investors that are taking office buildings and taking chunks of them and refitting them to lab space. Unheard of just a few years ago.
Yeah. So how do you see the future of investing really kind of shifting with regards to the whole COVID environment, the new, paradigm shift that we're in, people working from home, new configuration of the workspace, transportation, all that jazz?
Well, it's discussion. Yeah, go ahead, Daniel.
So it's what are going to be the permanent changes, and if we get on 18 months down the road, as Joseph said, and companies start saying, well, I don't want to pay that expensive Manhattan rent for 500,000 square feet. I only need 100,000 square feet, and it's just going to be a training center. And then I'm going to get cheaper space in Westchester, New Jersey, and Long Island. There's a paradigm shift, and you have way too much square footage in Manhattan. If business travel, if companies say, you know what, I can cut my business travel by 50%. These Zooms aren't terrific, but they're working for us. Wow. The impact of that on hospitality, in certain flags. I mean, Marriott's the king flag because of their rewards program. Well, if guys aren't accumulating points, then maybe not so much. There's so many unknowns. It's really fascinating from an academic perspective, but as an investor, it's very challenging.
Yeah, I think like every sector has differences, but the way I look at it is that the COVID-19 is an accelerator of some shifts that was happening in our sector. In the CRE sector, pricing was too frothy. We had an incredible long, protracted recovery and growth period. That needed correction, especially in our sector. When you have growth going out this far, you tend to have undisciplined investors coming in and developers coming in, adding supply and stock into the market that it does not belong in wherever they're belonging to. So you don't get that correction that you would normally get in a 7 year cycle. We had a little bit of too long of a cycle. From a accelerating perspective, you already had that shift going in the retail sector, depending on where you are. In New York City, 6 years ago, the first thing we always wanted to do was how do we expand retail beyond just the ground floor? So retail was always considered in 2014, and I've done probably the most expensive retail in the country at about 50,000 square feet per square on Fifth Avenue and 57th Street. We were restructuring retails where we were taking the tenants from just the ground floor and then taking them vertically, and I try to fit more tenants on the ground floor because you need the ground floor for entrances. All of that has shifted pre-COVID, and then COVID has obviously completely accelerated that change. So there's some allocations going on, industrials getting heavily priced versus hotels, discounting incredibly big in hotels now. Market has already discounted off the bat 20, 30%, right? I'm bidding on multiple properties, probably close to 30 to 40%, even below the lender's basis. Lender's basis tradition about 65% of the value. I'm bidding below that, and there's considerations being taken. So I would just caution that CRE should be looked at as a 5-year to 10-year kind of investment, that the 2-3 year shifts will happen, and you got to get priced for that risk. But I wouldn't say across the board that the sector is shifting. I think there's a standstill going on in a lot of parts of CRE, but I don't think there's a monumental shift, as everybody says in every recession.
Hey guys, we've got about 5 to 10 minutes. I think Pat Farrell had a question. Pat, did you want to ask it? Pat?
I think he's muted.
Okay, okay, since I don't hear Pat, I'm gonna ask it myself. So it says the Palmer House in Chicago is an example of a large chain who was just forced to close. This is an example of a business that really can't be refitted easily. Do you see these just remaining empty indefinitely?
Yeah, so kind of on the closure end, on the hotel side, we've never seen this before. Major markets are closing hotels about 25% of their inventory as of July. We were never seen that before. We saw that a little bit in New York City in 9/11, and that was just New York City. We didn't see that in the Great Recession. That is how destructive the top line of revenue loss is. That no property, almost no property in the country in top 25 markets are going to be able to pay debt service. In April and May, you couldn't make GOP, which is before your debt service, taxes, and insurance. So that's how deep the recession is in our sector. That now leads to other assets. But going back to that whole acceleration conversation, the Palmer House was going to get repurposed from a whatever that brand was before to another brand. And I think that conversation certainly has decided to go otherwise. Palmer House is one of the oldest continuously operating hotels in the country. So you could see that it was kind of getting less competitive to the newer stock. So that's the kind of a question about Palmer House. You're seeing that in a lot of the older hotels in New York City as well. They're no longer going to come out of this as a hotel. They're just simply not competitive with the new stock that came in. And that's, once again, the market accelerating and then destruction and then recreation, right? That's what every recession does. That's what you're going to see now.
I think
Pat,
there's great concern as well for the tax base in Chicago and what could happen there.
Yeah.
So certain markets are going to be hurt more than others.
Right, and that got priced in before COVID. So imagine what COVID is going to do to the balance sheets of municipalities for the next year. That's, once again, my biggest concern. But you got to get priced for that. There's always pricing, right? There's always ways to adjust your pricing when you're on the buy side as well as the sell side. You just have to be smart enough to price that in.
Yeah, I think one of the things that we've run into in our group is that COVID has not caused a lot of the problems, but it's accelerated things that were just kind of inevitable going to happen over time. As you just said, Joseph, they weren't able to upgrade. So, Dave McCurry, did you have a question?
Yeah, I did. Can you hear me?
Yes.
So just by way of introduction, I'm a lead advisor to virtual family office clients, and I need to advise them into the CRE space as a way to diversify their portfolios. And I'm trying to find, where are the good CRE investment opportunities now, despite all this softness. And so I'm wondering about cell towers. What's your take on that as an opportunity, and where an investor, how they may get invested into that space?
Marty, may I touch on this?
Please.
Good. There are two answers for your question. Depends on the nature of the family business model. If the family is into the involved in operations, there are a lot of today a lot of opportunities that will come out of funds that have fixed exits, especially those funds that were initiated in the 2015-16. They are forced to sell to pay back their investors. So those funds today, they don't have the luxury of pick and choose of buyers and to be a strong negotiators. They need to unload those assets. So that's one opportunity. Second opportunity is to rely on outsourcing of private equity and other wealth managers to make introductions to principals that have shortage of capital. Those will be today immediately in need for either sell or to have a joint venture where they will have a capital injection with a family that has familiarity with the sector. The cell towers for me is a small niche. Would it be going on the long term? Yes, but again, I think it will become obsolete in the next 10 years, as most of the internet providers will be relying on the satellite connections to connect the world together. So my immediate advice for fellow family offices will be as such.
Hey guys, this might be a good time as we close up to give our final remarks and thoughts about the marketplace. Kyle, well, let's have Joseph kind of take us in.
Sure. As we talked about it, and maybe myself a little bit too much about how disruptive COVID-19 has been, how much the sector has gone down. But once again, for me, as the saying goes, never let a good recession get by you. And that's kind of the way we're looking at it. Every type of destructive factors that come into the market, secular or otherwise, you got to look at it and saying, where's once again, the winners and losers. So if you're on the buy side of the equation, I will say a couple of things. One, be patient. The window of opportunity is 18 months. There are sector risks like real estate taxes that you need to be mindful for. And then discounting is happening. Across the CRE, not equally. On the hotel side, there's an incredible amount of structured finance deals that if you're in any one of those, they're all going to have a lot of losses and an inability to rework them out. So if you're on the buy side of the equation, a lot of good opportunities. We're seeing it today. We think we're going to see a lot more of it in the near term.
Kyle?
Yeah, just need to echo Joseph's thoughts that there always will be opportunities. Just remain diligent in them and be smart about how you allocate and how you exit. The tax code allows for you to, again, continue stimulating the economy, and done correctly, you'll always have more money to work with. Let's lock in those gains and have more in your pocket for the next purchase.
Mm-hmm. Jamil, what are your thoughts?
Definitely watching the legislators today fighting over the second stimulus tells me that we are still in a deep dive. We are still in a diving projectile. We did not reach the trough yet, because when the stimulus dry up and the government run out of printing abilities and our debt reaches close to 30 trillion, the government cannot be the mother for every citizen out of 330 million people. We have to account for all those losing sectors of the economy and the amount of labor that will not be able to go back to work. And how long would it take for those people to retrofit their skills and adapt to starting from driving for Amazon for $20 an hour and rebuilding their economic stability moving forward. So till now, as always, all my life as an investor, I was optimistic. Today, between now and November 3rd, I still see a gray picture in the United States, in the streets, in Washington, and in many other states where more insecurity is taking place. So all these M&As and others, these are only a small fraction of the economy of the United States.
Daniel.
Thanks, Mario.
I'll just make one comment here. Camille, I think you're right in terms of the havoc being caused in other countries, because, and I want to have a panel on this in the future. I don't know what debt is not denominated in other countries, but I have a relative who owns 10 restaurants in Lima, Peru right now, and he's had to shut down all of them. I don't know if his debt is denominated in dollars or if it's in, soles or whatever, but I think it'd be an interesting topic of conversation, which is what is the debt impact on all of these other countries who are being hit and devastated by COVID. So anyway, keep on going. Sorry.
Marty, I just to add to this, from all the international channels that I have access to watch, I'm sure other people have all those new gadgets of boxes. The amount of people that are impacted by COVID till now, and bodies are collected in the streets 2-3 days after the fact. I mean, I receive videos on WhatsApp from friends and from business colleagues. The numbers in the third world of victims is just scary. There is still a lot of data that is not being collected on third world countries.
No doubt, and I know there's a tremendous human suffering and grief. Again, I'm just trying to focus on what are all these businesses and their debt denominated in? Because I don't see how the ripple can't be catastrophic outside the United States if debt is denominated in dollars. Anyway, Dan?
So I think the folks tuning in today are hearing a common theme here. There's a lot of pain. So short term, lots of opportunities and distress. If you want to access it, you got to find a good manager with good access to the marketplace. I'd caution people against kind of the new best thing, industrial. Industrial is not new. It's hot right now, but rents have doubled in the last couple of years. And frankly, this stuff is real cheap to build. And with artificial intelligence coming, I'm not sure that last mile in 5 years is going to look like it does today. So again, you can't beat a good manager if you want to get into real estate.
And just as I'll give a quick final remark myself, is certain things going into certain recessions or whatnot, like industrial, self-storage, mobile home parks, we've seen to do pretty well. And although a lot of folks now also focus on distressed opportunities, there's a lot of dry powder for distressed opportunities. Take advantage of it.
And just to comment on that, we had Wharton Equity Partners on back in April or May discussing industrial, and they sold 3 industrial significant to major online retailers, let's say, who needed distribution. So industrial's been a great place to be. I think even if you own real estate, industrial real estate off of Exit 8 on the New Jersey Turnpike, which is kind of a legendary place not to own. So listen, guys, fantastic. I'm actually going to clap here. We've got 10 people, so great job. And for those people who are here, don't forget there's a grab bag of gifts over that you should take with you when you leave.